Introduction to Real Estate Metrics. Understanding key financial metrics is crucial for success in real estate investment. These metrics provide a standardized way to evaluate a property's income-generating potential and overall profitability. Without a clear grasp of these tools, investors risk making uninformed decisions that could lead to significant losses. This course will focus on three fundamental metrics: net operating income, NOI, capitalization rate, CAP rate, and return on investment, ROI. Each metric offers a unique perspective on a property's financial health and investment appeal. These metrics are not just for large-scale commercial investors. Even individual buyers of rental properties can benefit immensely from applying these principles. They help in comparing different investment opportunities, negotiating fair prices, and projecting future returns. By the end of this course, you will be equipped to confidently analyze real estate deals using these powerful financial instruments, enhancing your ability to identify lucrative ventures and manage risks effectively. What is net operating income, NOI? Net operating income, or NOI, is a fundamental metric used in real estate to assess the profitability of income-generating properties. It represents the annual income generated by a property before accounting for debt service, mortgage payments, income taxes, and capital expenditures. Essentially, NOI provides a clear picture of a property's operating efficiency and its ability to generate revenue from its core operations. It is a critical figure for investors, lenders, and appraisers alike. NOI is calculated by taking the total revenue generated by a property and subtracting all necessary operating expenses. This figure is often considered the engine of a property's financial performance, as it directly reflects the income available to cover financing costs and provide a return to equity investors. Understanding NOI is the first step in accurately valuing a commercial or investment property, as it forms the basis for other advanced valuation techniques. Components of gross rental income. Gross rental income is the starting point for calculating NOI and represents all potential revenue a property can generate. This includes scheduled rent payments from tenants, which typically form the largest portion of income. However, it also encompasses other income streams that contribute to the property's overall revenue. Understanding all these components is vital for a comprehensive financial analysis. Other income sources can significantly boost a property's gross revenue. These might include fees for laundry facilities, parking fees, pet fees, late payment charges, and even vending machine income in larger commercial properties. It is important to accurately account for all these diverse income streams to get a true picture of the property's earning potential before any expenses are considered. A thorough review of leases and operational records is essential to capture every income component. Understanding operating expenses. Operating expenses are the costs associated with running and maintaining a property, excluding debt service and income taxes. These expenses are crucial to consider because they directly reduce a property's gross income to arrive at the net operating income. Accurately identifying and categorizing these expenses is paramount for a realistic financial assessment. Miscalculating operating expenses can lead to an overestimation of a property's profitability. Common operating expenses include property taxes, insurance premiums, utilities, if not paid by tenants, property management fees, maintenance and repairs, and advertising costs for vacancies. It is important to distinguish between operating expenses and capital expenditures, which are costs for significant improvements or replacements that extend the property's useful life. Operating expenses are recurring costs necessary for day-to-day operations, ensuring the property remains functional and attractive to tenants. Calculating net operating income, NOI. The calculation of net operating income is straightforward once all revenue and operating expenses are identified. The formula is simply gross rental income minus operating expenses equals NOI. This calculation provides a clear, unencumbered view of a property's income-generating capability before any financing decisions are factored in. It is a crucial step in evaluating any potential real estate investment. To illustrate, imagine a property generating $100,000 in gross rental income annually. If its total operating expenses, including taxes, insurance, and management fees, amount to $30,000 per year, then its NOI would be $70,000. This $70,000 is the money available to cover the mortgage and provide a return to the investor. Always ensure you have a comprehensive list of both income and expenses to achieve an accurate NOI figure, as omissions can significantly skew your analysis. Importance of NOI in valuation. NOI is arguably the most critical metric for valuing income-producing properties. Appraisers and investors often use NOI as the primary input for various valuation methods, most notably the income capitalization approach. A higher NOI generally indicates a more valuable property, assuming all other factors remain constant. This is because NOI directly reflects the property's ability to generate cash flow from its operations. Lenders also heavily rely on NOI when underwriting commercial real estate loans. They use it to calculate debt service coverage ratios, which assess a property's ability to cover its mortgage payments. A strong NOI provides confidence to lenders that the property can sustain its debt obligations. Therefore, maximizing NOI through efficient management and strategic income generation is a key objective for any real estate investor looking to enhance property value and secure favorable financing. Introduction to Capitalization Rate, cap rate. The capitalization rate, commonly known as cap rate, is a crucial metric in real estate that expresses the relationship between a property's net operating income, NOI, and its current market value. It is essentially the rate of return on a real estate investment property based on its expected income. Investors use the cap rate to estimate a property's potential return and to compare different investment opportunities quickly. A higher cap rate generally indicates a higher potential return, but also potentially higher risk. Think of the cap rate as a snapshot of a property's unleveraged yield. It does not account for the effects of debt financing, focusing solely on the property's inherent income-generating ability relative to its price. This makes it an excellent tool for comparing similar properties in the same market, as it provides a standardized measure of value. Understanding cap rates is essential for making informed buying and selling decisions in the investment property market. Cap rate formula and calculation. The cap rate is calculated using a simple formula. Cap rate equals net operating income, or current market value or purchase price. This formula allows investors to quickly determine the potential rate of return an investment property can generate without considering financing. It's a fundamental tool for initial property assessment and comparison. For example, if a property has an NOI of $70,000 and its current market value is $1 million, the cap rate would be 7%. $70,000 over $1 million equals 0.07 or 7%. This means that for every dollar of property value, the property generates 7 cents of net operating income annually. Conversely, if you know the NOI and the desired cap rate, you can estimate the property's value. Property value equals NOI divided by NOI cap rate. This flexibility makes the cap rate an incredibly versatile metric. Interpreting cap rates. Interpreting cap rates requires understanding market dynamics and risk. A higher cap rate generally suggests a higher potential return on investment, but it can also indicate higher risk or a less desirable property. Conversely, a lower cap rate often implies lower risk, a more stable income stream, or a property in a highly sought-after location. It's crucial not to view cap rates in isolation, but within the context of the specific market and property type. For example, a cap rate of 4% for a prime commercial property in a major metropolitan area might be considered excellent, reflecting stability and strong tenant demand. However, A 4% cap rate for a property in a declining neighborhood would be a red flag, indicating an overvalued asset or significant underlying issues. Investors must compare a property's cap rate to similar properties, comparables, in the same market to determine if it represents a good value. Factors influencing cap rates. Several factors significantly influence a property's cap rate, reflecting both market conditions and property-specific characteristics. Understanding these influences is key to accurately assessing a property's value and potential return. These factors can cause cap rates to fluctuate, making it essential for investors to stay informed about current market trends. Key factors include the property's location, asset class, example multifamily, office, retail, tenant quality and lease terms, interest rates, and overall economic outlook. For instance, properties in prime locations with stable, long-term tenants typically command lower cap rates due to their perceived safety and reliability. Conversely, properties in emerging markets or with higher vacancy risks might have higher cap rates to compensate investors for the increased risk. Economic growth, or lack thereof, also plays a significant role, impacting demand for real estate and thus cap rates. Comparing cap rates across properties. Comparing cap rates is an effective way for investors to evaluate different investment opportunities within the same market or asset class. It provides a standardized metric that allows for apples-to-apples comparisons, helping investors identify undervalued or overvalued properties. However, it's crucial to ensure that the properties being compared are truly comparable in terms of location, condition, tenant base, and risk profile. When comparing, a property with a significantly higher cap rate than its comparables might indicate a higher risk or a potential opportunity if the risk is manageable. Conversely, a property with a much lower cap rate than its peers could be overvalued or simply represent a very stable, low-risk investment. Always consider the context. A 6% cap rate for a Class A office building might be attractive, while the same 6% for a distressed property might be concerning. Thorough due diligence beyond just the cap rate is always recommended. Cap rate versus cash-on-cash return. While both cap rate and cash-on-cash return are important metrics, they serve different purposes and provide distinct insights into a property's profitability. The cap rate focuses on the property's unleveraged return, comparing NOI to the total property value, ignoring any debt financing. It's a measure of the property's inherent income-generating ability. Cash-on-cash return, on the other hand, measures the annual pre-tax cash flow generated by the property relative to the actual cash invested by the investor. This metric explicitly accounts for debt service, providing a more personalized view of the investor's actual return on their out-of-pocket equity. It is calculated as annual before-tax cash flow divided by total cash invested. An investor might accept a lower cap rate for a property if they can achieve a high cash-on-cash return through favorable financing, demonstrating the power of leverage. Introduction to Return on Investment, ROI. Return on investment, or ROI, is a widely used performance measure to evaluate the efficiency of an investment or to compare the efficiency of several different investments. In real estate, ROI helps investors understand the profitability of their ventures relative to the initial cost. It is a versatile metric that can be applied to various aspects of an investment, from a single property to an entire portfolio. ROI is typically expressed as a percentage and aims to answer the fundamental question, how much money did I make or lose relative to the money I put in? A positive ROI indicates a profit, while a negative ROI signifies a loss. While simple in concept, calculating ROI accurately requires careful consideration of all costs and returns associated with an investment, including purchase price, renovation costs, rental income, and eventual sale price. ROI formula and basic calculation. The most common formula for calculating ROI is ROI equals net profit divided by cost of investment times 100%. Net profit is the gain from an investment minus the cost of the investment. The cost of investment includes the initial purchase price, closing costs, renovation expenses, and any other capital outlays. This formula provides a clear percentage return on the initial capital deployed. For example, if you purchase a property for $200,000, spend $50,000 on renovations, and then sell it for $300,000, your net profit would be $50,000. $300,000 minus $250,000. Your total cost of investment is $250,000. Therefore, your ROI would be $50,000 divided by $250,000 times 100% equals 20%. This calculation is straightforward for a single completed transaction, but becomes more complex for ongoing income-producing properties. Different types of ROI in real estate. While the basic ROI formula is useful, real estate investors often utilize several variations to gain a more nuanced understanding of their returns. These different types of ROI account for various factors, such as the time value of money, the impact of financing, and the duration of the investment. Understanding these distinctions is crucial for a comprehensive financial analysis. Common types include annualized ROI, which accounts for the time period of the investment, and leveraged ROI, which considers the impact of debt financing on the return. Another important variation is cash-on-cash return, as discussed earlier, which focuses on the actual cash invested. For long-term investments, metrics like internal rate of return, IRR, and net present value, NPV, are often used, which incorporate the time value of money, providing a more sophisticated measure of profitability over time. Each ROI type offers a unique lens through which to evaluate an investment's performance. Leverage and its impact on ROI. Leverage, often in the form of mortgage financing, can significantly amplify returns in real estate investments. By using borrowed money, investors can control a larger asset with a smaller amount of their own capital, potentially leading to a higher ROI. This is because if the property's value or income increases, the appreciation or profit is applied to the investor's smaller equity stake, magnifying the percentage return. However, leverage is a double-edged sword. While it can boost profits, it also magnifies losses if the property's value declines, or if income streams falter. Interest payments on the debt also add to expenses, reducing cash flow. Investors must carefully assess their risk tolerance and the stability of the property's income before employing significant leverage. A prudent approach involves balancing the potential for increased returns with the inherent risks associated with borrowing. Comparing NOI, cap rate, and ROI. While NOI, cap rate, and ROI are all crucial for real estate analysis, they provide distinct perspectives and are used at different stages of the investment process. NOI is the foundational metric, representing the property's operational profitability before financing. It's a raw measure of a property's income-generating power. The cap rate takes NOI and relates it to the property's value, offering a snapshot of the unleveraged return and a quick comparison tool for similar properties. It helps in valuing a property based on its income. ROI, on the other hand, is a broader measure of overall investment profitability, often considering the entire life cycle of an investment, including financing and eventual sale. It tells the investor how much they actually gained relative to their cash invested. Together, these metrics provide a comprehensive financial picture, allowing investors to make well-rounded decisions. Using metrics for investment decisions. These three metrics, NOI, cap rate, and ROI, are indispensable tools for making informed real estate investment decisions. They help investors evaluate potential acquisitions, assess the performance of existing properties, and strategize for future growth. A holistic approach, considering all three, provides the most robust analysis. When evaluating a new property, start with NOI to understand its operational income. Then, use the cap rate to compare it against market benchmarks and estimate its value. Finally, project the ROI, considering your financing strategy and expected holding period to determine your personal return on invested capital. For existing properties, regularly tracking these metrics helps identify areas for improvement, such as reducing expenses to increase NOI, which in turn can boost the property's cap rate and your overall ROI upon sale. Limitations of these metrics. While NOI, cap rate, and ROI are powerful tools, it is crucial to understand their limitations to avoid misinterpretations. No single metric tells the whole story, and relying solely on one can lead to flawed investment decisions. These metrics are snapshots and do not always capture the full complexity of a real estate investment. For instance, NOI does not account for capital expenditures or debt service, which are significant costs. Cap rates are highly dependent on market conditions and comparable sales, which can be subjective or scarce. ROI, especially simple ROI, does not consider the time value of money or the duration of the investment, which can distort long-term profitability assessments. Furthermore, these metrics do not directly factor in qualitative aspects like property condition, neighborhood growth potential, or management quality. Always use them in conjunction with thorough due diligence and other qualitative assessments. Conclusion and key takeaways. This course has provided a comprehensive overview of net operating income, NOI, capitalization rate, cap rate, and return on investment, ROI, in real estate. You have learned how to calculate each metric, interpret their meanings, and understand their critical role in evaluating investment properties. These tools are fundamental for anyone serious about making informed decisions in the dynamic world of real estate. Remember that NOI is the property's operational profitability, cap rate is a valuation and comparison tool, and ROI measures your overall personal return on investment. Always use these metrics in conjunction with thorough due diligence, market research, and an understanding of your specific investment goals and risk tolerance. By mastering these concepts, you are now better equipped to analyze real estate opportunities, negotiate effectively, and build a successful investment portfolio. Continue to learn and adapt to market changes, as the real estate landscape is ever evolving.